Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. Let's take a look at the stories for the day. The pandemic has left hundreds of thousands of people jobless in the last 2 years. But at the same time, it has also generated hundreds of thousands of jobs in some sectors, including in the gig industry. We now get our food and other essentials within barely 15 minutes of placing an order. What started out as a necessity has now become a convenience. Grofers rebranded to Blinkit and pivoted to instant commerce. Zepto banked $100 million and Dunzo raised funding from Reliance Industries. And now Swiggy has turned a decacorn. It is planning to go big on quick commerce. This report explores how Swiggy doubled its valuation in just 6 months.
Bengaluru-based food tech platform Swiggy announced on Monday a $700 million investment from marquee investors led by Invesco, almost doubling its valuation to $10.7 billion. On the other hand, the market capitalization of Swiggy's rival Zomato has plummeted in the last few trading sessions to close at $9.6 billion on Monday. So clearly, Swiggy's valuation has surpassed that of its main rival Zomato, which went public last July. With this, Swiggy has turned a decacorn, a term that refers to startups valued at more than $10 billion. Startups that have attained this status include Flipkart, Byju's, Paytm, and Oyo. The gross order value of the company's core food delivery business has nearly doubled in the last year, Swiggy said, adding that the latest fundraise will allow it to accelerate growth on its core platform of food delivery segment, in addition to making investments in Instamart. Instamart is Swiggy's quick commerce grocery service, which is set to reach an annualized gross merchandise value or GMV run rate of $1 billion in the next 3 quarters. Swiggy recently said that it plans to invest $700 million in Instamart, which took just 17 months to hit the same level of GMV that Swiggy's food delivery business achieved in 40 months. With hyperlocal delivery becoming all the rage, Swiggy is sharpening its focus on Instamart, which has expanded to 19 cities in the past few months. However, quick grocery delivery is a capital-intensive business, and companies in India have only started to build out the infrastructure to cater to the large population. This is why the new round of funding came just 6 months after Swiggy raised a mammoth $1.25 billion last July, underscoring the capital required to expand its grocery delivery business. Utkarsh Sinha of Bexley Advisors is here to tell us why Swiggy is commanding a decacorn status.
I think both Swiggy and Zomato have had a tremendous fillip in their business post-COVID. The model has shifted entirely from going out and consuming to being able to order in, and they've both benefited from the change in consumer behavior that the pandemic brought about. There was also a lot more of the consumer wallet which was available for such spends. What has also happened is that a lot of people who are on the periphery in terms of from a consuming perspective have gotten used to transacting online. So not just in terms of ordering food, but also in terms of ordering groceries, and there are a lot of factors that will encourage an investor who's got a long-term perspective and who sees an IPO window in Swiggy's future to come in and invest and hopefully get a respectable return fairly early on. Invesco, for example, is one of those investors who eyes a lot of the companies which are headed towards an IPO or are likely to head towards an IPO soon. So the expectation is that given the fact that Zomato's scale is similar to Swiggy's scale, coming in at a valuation which is similar, and then going in for an IPO a few months or a year or so down the line, still ensures enough room for returns for the investors in this round. So I think a lot of it is driven by the fact that there's proximity to IPO. The depth of India is fairly unexploited at this point. In terms of both Swiggy and Zomato, one of the advantages that they have is that they are mostly asset light. It's a gig economy model, and there is therefore an opportunity if the economics works out for on a per delivery basis. My view personally is that the food delivery market, the delivery market in general, is more of a 50-40-10 model, where 50% to the leader, 40 to the second, and everybody else in the bottom 10. So I think that it's likely to play out like that. Both Swiggy and Zomato are so close to each other in terms of scale that it's very difficult for one to absorb the other unless there's a lot of momentum for this at the senior level, and I don't see either of the CEOs vying to get absorbed by the other party.
Behind the fast grocery delivery of these companies are dark stores. A dark store typically caters to a radius of 2 kilometers, and the likes of Dunzo, Instamart, Blinkit, and Zepto currently have 20 to 30 such micro fulfillment centers in the top 10 cities where their 10 to 20-minute delivery services are operational. Swiggy has gone beyond grocery with Genie, its pickup and drop service that is now present across 68 cities, while its meat delivery service and daily grocery service Super Daily is present across all major Indian cities. While startups are eager to jump on the quick commerce bandwagon in search of the next big market opportunity, the category is yet to prove its sustainability in the long term. If examples from European countries are anything to go by, consolidation in the instant grocery market is likely in India too.
The pandemic threw a set of challenges which companies had never confronted before. It led to a marked shift in the way they worked. After Swiggy and the gig economy, let's turn our attention to the IT sector to see how it dealt with these challenges. In an interview with Shurujit Dasgupta, Accenture's Senior Managing Director and Lead for India Business, Piyush Singh shares his company's experience and more. Let's listen in.
Nice having you with us.
Same here.
There has been, obviously the pandemic has made everybody relook at their business, and there has been waves of it. So each wave has come out with its new challenges. So if you could sort of briefly tell me what have you gone through, and also with the new the existing Omicron wave, uh, what are the sort of challenges that has thrown in place?
The waves have done two things. On one hand, they have prepared most organizations quite well to to not to be ready for this uncertainty. The second is that they have reaffirmed that there is an uncertainty. The challenges that the world that we're living in will continue to have the challenges of disruption. Disruptions in supply chain, disruptions in availability of your human capital, disruptions in the way you can reach out to your customers, and interact with your customers, and changing a very, very dynamically changing consumer preference bucket. From that perspective, we as well as the broader industry has to be on a very sharp watch on picking on both customer trends as well as trends in the way how our workforces are feeling and dynamically responding to it.
How do you see the Indian business for you? And do you see that as a new area where you will find larger revenues coming in from India rather than, I mean, obviously you will have bigger revenues from everywhere, but I'm saying, the focus on India would be different for you.
Oh, absolutely. Look, I mean, India is is among the economies that we are heavily invested in, and we have a very strong positive outlook on that. Today, you say, yes, in certain parts of the forums, we'll always talk about, India as our largest employer base. You saw us make an announcement about our work that we're doing with, the digital initiative with Coal India, for example, a massive in transformation of, the largest coal miner in the world, and a transformation that is at the heart of digitizing, their business. You've seen announcements that we've made in the retail space. Our work with we work with Nestle, our work with Unilever or Hindustan Lever, our work with Shopper Stop, all in the area of e-commerce transformation, all in the area of transforming the way they interact with their customers, they reach out to their customers, and heart of transforming their business. You've probably seen our announcements with the work that we've done with or doing rather with with Bank of Baroda, RBL, so various banks, again, all again in the area of they drive using use of data and analytics to drive business performance, to uplift business performance. The role that we want to play is a very deep role in these transformations. So the industries that I've mentioned and a few others, but we have a very clear focus on the industries that we want to operate in any economy that we operate, including India. And within that, we are again very careful about making sure that we are working with organizations or only organizations with whom we can have long-standing partnerships.
From a consultancy point of view, what are the areas do you think that transformationals are needed in India, where you are concentrating on, or where when you talk to industry, where they are looking at, and what is the kind of feedback that you are getting from the industry or what they want?
The way I would put it is India is very value sensitive, right? So it's more than the price that our client organizations want to track what is the value realization for the investments. I think organizations are willing to make the investments, and they are in the areas that we spoke about. They are in the areas of how to transform your customer interface, and make that more digital. How to transform your supply chains and make that more sustainable, more digital. How to transform the internal enterprise, for it to allow digital collaboration, allow work from anywhere kind of work culture. So those are the areas where organizations are transforming. How to enable all of this through a much more data-driven decision making. So how to enable that from a much more cloud-native IT infrastructure. So these are all the three broad areas where I'm seeing organizations wanting to invest in. The key demand is, as I said, to make sure they're seeking to understand how value realization will happen.
Great, wonderful talking to you.
Thank you. Same
Pleasure.
here.
Yeah.
Have a good one. Talk soon.
Thank you.
Moving on from Accenture, let's look at the Indian stock markets, which finally saw some upward momentum after several days of losses. The US Fed signaled that it would begin raising rates as early as March is the main reason behind the stock market's volatile start to the year. And while the US Fed may not begin increasing rates just yet, the central bank is expected to maintain a path to tighter policy this year. Our next report delves into what the market expects the Fed to deliver later tonight and the outlook for Indian equities in the near term.
Inflation rate in the US hit its fastest pace in nearly 4 decades last year at 7%, as pandemic-related supply and demand imbalances, along with stimulus intended to shore up the economy, pushed prices higher. This accelerating inflation, analysts believe, could cause the US Federal Reserve to get even more aggressive than economists expect in the way it raises interest rates this year. We are a bit concerned about the inflation rate that is running very high in the US, which could prompt the US Fed to increase interest rates much faster in the future. Nevertheless, the market has already priced in faster tapering and one rate hike by March 2022. In this backdrop, global equity markets have remained on the edge ahead of the US Central Bank's two-day meeting that started Tuesday. While they expect no action regarding interest rates just yet, they feel the committee will look to hike rates in March 2022. If that happens, it will be the first increase in the central bank's benchmark rate since December 2018. Those at Rabobank International too agree and expect the US Fed to start hiking rates as we head deeper into 2022, with the first rate hike in March 2022. Recent testimony, speeches and interviews have made it clear that the FOMC is gung-ho and ready to start hiking in March. Unless we see a setback in the real economy, we expect the Fed to hike each quarter this year. And even as the markets have discounted the possible hike in rates by the US Central Bank, experts say the volatility is here to stay and investors should remain cautious. Excessive volatility is likely to continue for a few more days until clarity emerges out of the crucial Fed meet. The market is discounting a hawkish Fed. If the US central bank does sound very hawkish and indicates 4 rate hikes in 2022, the market will again turn weak. That said, the Indian markets, which saw a stellar run for most part of 2021, have underperformed in the past few months. The benchmark Nifty 50 has declined 7% from its October high of 18,339, as against around 4% decline each in the United States' Dow Jones Industrial Average and MSCI Emerging Markets Index. The MSCI World Index, meanwhile, has declined around 5%. China's Shanghai Composite Index seems to have bucked this trend, having risen around 1%. Will this underperformance continue? Let's go to Deepak Jasani, Head of Retail Research at HDFC Securities, for his views on the road ahead for the markets in the short term.
See, we outperformed earlier, no? So now we are there's some sort of a mean reversion is happening. We are now underperforming, and we'll sort of on a longer period, maybe we'll be on par with other emerging markets. Now, going forward, we have some two events, budget and US Fed meet and our own RBI meet. So I think till 6th, markets could remain volatile. And if the budget outcome is good, then maybe we will stop this underperformance and either be on par or start outperforming.
The markets will remain closed on Wednesday on account of Republic Day and will react to the outcome of the US Fed meeting when it resumes business on Thursday, January 27.
Experts believe that the upcoming union budget will offer some respite to the purses spooked by US Fed uncertainty and rising crude oil prices. The money bill is the most crucial part of any union budget. It comes under the finance bill and tells us about the taxation and government spending. Here's more about the money bill.
A bill is a statute in draft. It has to receive the approval of both the Houses of Parliament and also the President's nod to turn into a law. Procedurally, bills can be divided into 4 parts. There are ordinary bills, money bills and finance bills, ordinance replacing bills, and constitutional amendment bills. Apart from the money and finance bills, the other 2 bills can be presented in either of the houses. But the money and finance bills have to be introduced in Lok Sabha. The upper house of the parliament has limited power over it. Let us understand this through an example. Before it turned into an act in 2016, the Aadhaar bill was introduced as a money bill in Lok Sabha, where it easily sailed through as BJP enjoyed a majority in the lower house of the parliament. It also led to a row as the opposition didn't agree with the government's classification of the Aadhaar bill as a money bill, in which the Rajya Sabha has no power to veto. Then in 2018, a 5-judge Supreme Court bench had held its constitutional validity. The bench was led by the then Chief Justice of India, Deepak Mishra, and the sole dissenter was Justice Chandrachud. Let us now understand what a money bill is. Defined in Article 110 of the Constitution, Money Bill contains tax proposals of the government telling about the new taxes and changes in rates of existing taxes. It also contains government's expenditures, revenues, and borrowings. According to the Constitution, a money bill contains the imposition, abolition, remission, alteration, or regulation of any tax, but the imposition of local taxes doesn't come under the purview of the money bill. The regulation of the borrowing of money by the union government also comes under its ambit. The payment of monies into or the withdrawal of monies from Consolidated Fund or the Contingency Fund of India also come under this bill. As explained in an earlier episode, the Consolidated Fund of India contains direct and indirect taxes and loans taken by the government. Loans or interest given to the government are also put in this fund. The union government needs parliamentary approval to deposit or take out money from it, and this is done through the introduction of the money bill, while the Contingency Fund of India is an emergency fund. The appropriation of money out of the Consolidated Fund of India and the declaring of any expenditure charged on the Consolidated Fund of India or the increasing of the amount of any such expenditure comes under the money bill. So, for example, if the government wants to increase the salary of the President of the country, which is drawn from the Consolidated Fund of India, it will have to introduce a money bill. The same process will have to be followed if the government wants to raise the salaries of the Lok Sabha Speaker or the Chairman of Rajya Sabha. The receipt of money on account of the Consolidated Fund of India or the Public Account of India, or the custody or issue of such money or the audit of the accounts of the union or of a state comes under the money bill. And last but not the least point, any matter incidental to any of the matters specified above also comes under the money bill. There is no exact definition of the word incidental given in Article 110. So for long, the governments have been allegedly misusing this clause to expand the ambit of the money bill. The opposition alleges that it happened in the Aadhaar case. The Speaker of the Lok Sabha takes the final call if a bill is a money bill or not, and his decision cannot be challenged in any court of the country.
Did you know that a defeat of the money bill on the floor of the Lok Sabha leads to the fall of the government? That's all we have for you today. The Morning Show team wishes you a happy Republic Day. We'll be back tomorrow morning with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.